we've got our investment expert, Roger Montgomery. He's back to give us his analysis of the shares we should and shouldn't be putting to our portfolios. And we also have a viewer question. Roger, thanks for joining us on the program.
Nice to see you again.
Yeah, and this is a pretty provocative question, Roger. And
oh, that's right. I'm used to when I'm on the show with you, mate. I'm kind of used to that.
But people forget that. People might think I'm opposed to you. Like, you're on this program.
No, what they don't get is off camera, we're in total agreement.
That's right. But also, you're the boy genius. That's why you're on the program.
Thank you very much.
But I play the contrarian, the devil's advocate. And that's why I often go for you. Whenever I see the jugular, I go for it. But I love this question. It comes from Masood.
Okay. But
first, like this email, where does it start? This viewer says, he may have spotted the weakness in Roger's investment technique. Here's what he had to say. I've noticed that you give Roger Montgomery a hard time when he's on your program, and rightly so, he adds, which I think is unfair. Yeah. With this in mind, I thought you might be interested in what he said on market moves a short time ago before appearing on your program. He said he was 90% invested in cash, which I thought was very strange a position for someone who's been a value investor for years and supposedly ignores the ups and downs of the market.
Well, now, let's stop on that. There's a problem. Let's stop there.
Okay, stop there.
Supposedly ignores the ups and downs of the market. Yeah. I ignore them to the extent that I don't look at them and I don't forecast them.
Right.
But the reality is that modern finance, it will. You happy for me to go on?
Oh, most definitely. So, I wanted to do it this way. Progressively go through the insulting observations.
Sure.
And give you a chance to get even. And I'll play Masood's role and get even with you as well.
Let's start with Buffett. Everyone knows of Buffett. In 2003, he came out and he said, I made a very big mistake not selling some of our bigger holdings when their prices were a lot higher and their intrinsic values were a lot lower.
Yeah.
He since learnt from that. He sold J&J to buy Goldman Sachs. He sold PetroChina when it reached intrinsic value. He even said that. He used those words. So there's a bloke who's actually said, look, for years and years and years, I've had this idea that you marry a stock and it's till death do you part. And he's since changed that. And people still believe that. But since then, he's been very different and he has been selling. I've done a lot of work in the time since being a fund manager. I've done a lot of research, and what I've found is a lot of what when you go to a financial planner, for example, and invariably they'll say to you, well, you're a moderate risk person, you should have a balanced portfolio with a bit of property and a bit of this and a bit of that and the other. All of that is based on modern portfolio theory. Now, modern portfolio theory itself is based on the work of someone called Bachelier, who in 1900...
Not a household name, but
in
your household is a household
exactly.
name.
So look, Markowitz, who came up with this idea that variances and covariances measure risk, so, you know, that William Sharpe based his work, he developed beta and the capital asset pricing model and the weighted average cost of capital, which we use to value, in fact, I think 390 odd companies out of the top 400 in the United States use the capital asset pricing model to make decisions about where to allocate capital. That was based on Markowitz's work. Now, Markowitz's work was based on Bachelier's work in 1900. Now, I'll keep this very short, but he had this idea, Bachelier had this idea that price changes are normally distributed. Right, so if you imagine a normal distribution curve, you've got an average price change, and then you've got one standard deviation which explains 65% of price changes, or 2/3 roughly, and then 2 standard deviations and 3 standard deviations. Now, I've got some stats for you here, just to explain this to you. So, the normal distribution curve of Bachelier said that the Dow Jones between 1916 and 2003 should have moved by more than 3.5% 58 times in that 90-odd year period. Should have happened 58 times. In actual fact, it happened 1,001 times. A move of greater than 4.5% in the Dow Jones should have only occurred 6 times on 6 days. It actually happened 366 times.
Okay. All right. So what does all this mean?
All this means is the normal distribution curve is wrong.
Wrong.
Prices don't work that way. They fall, and we've noticed this. We get crashes more often.
So if the normal distribution curve worked, is that an argument to hold stocks for a long time?
Exactly.
And the opposite.
But we've been mismeasuring risk. Modern portfolio theory and modern financial advice says that you should own a diversified portfolio of stocks and stay invested in the market, and you're going to do okay. And what everyone's found is, guess what? You don't do okay. You lurch from one crisis to the next. And so I've learnt this, and so I've made a decision that when I look at my information, and the vast majority of companies are expensive, I sell.
Yeah.
Okay, and that's what I've done. So
Are you 90% cash now?
no, I've since bought some stocks.
Let's keep going on.
Let's keep going. Yeah.
Is he telling us that throughout his investing life he has not come across enough good companies or enough low price opportunities to invest a big chunk of his cash?
Well, this goes back to what we've just said.
Yeah.
Of course I've found, I've got a public track record out there, people can go and dig it up.
Yeah.
Of course I've found
Do you
things
have
to buy.
one
But
company you've held you still got?
No.
Okay.
But there's been a company I currently hold is one that I've owned 2 or 3 times before.
Well, like Reject Shop, you're into that for a long time.
Reject Shop was a very long-term holding.
Yeah, okay.
Yeah.
He quotes from Warren Buffett frequently, and as you know, Buffett's approach is to invest in good companies at reasonable prices and hold them forever. And you've sounds like Roger is trying to be a market timer.
Company pricer rather than a market timer. So what I'm doing is I'm looking at individual businesses and I'm saying, you know what, this business's price has gone way ahead of even my estimate of its intrinsic value in 2 or 3 years' time.
Yeah.
I'm going to be sitting here with the risk of it going down, and in 3 years the value's not going to be catching up to even where it is today. And that to me, if I look at the risk-reward payoff of that scenario, to me the risk is much higher than the reward, and so I'll sell. I think it's important that you understand where the value is compared to the price. Otherwise you're flying blind. It's a little bit like driving a car blindfolded. If you know where the value is, then you're not going to pay too high a price, and you also won't sell too early.
But Roger, if you've got a company with intrinsic value at say $2 and the stock price is $5,
Yep.
and you're holding it, so your feeling is, well, I'm going to get out before the market wakes up and takes the price down to where it should be, $2.
Yeah, but here's the thing, this is the difference. If the value today is $2, but next year the value jumps based on an estimate of its prospects, it jumps to $6, then the price today at $5 might not be a reason to sell.
What about the old theory that a rising tide lifts all shares?
Precisely, and that's why
Do you agree with that cliche?
Oh, absolutely. You can do well just throwing darts at a dartboard in a rising market.
In your absence, but you might have heard me. Now you would have emailed me the next day if you heard me, teasing you.
Right.
But when Wesfarmers took off,
Yes.
I said, well, that won't make Roger all that happy. I know
Right.
you're not that sensitive anyway. But if people had listened to your brilliant analysis...
But no doubt when it went down, you also said, well, and Roger mentioned that it's... Okay. You only mentioned when it went up. That one day. Very good.
Yeah.
That's fair.
Yeah. No, actually, it was more than one day. It was a couple of days it went up.
Right.
But the point I was going to make is that often you can get into a share for the wrong reasons, considering what you say, like intrinsic, and you actually can do quite well.
Absolutely.
Yeah.
I'm not advocating... I'm not saying my way is the only way to invest.
No.
I'm just saying,
look, it sounds like it to people in the real world.
I just think it's a really rational and sensible way to approach markets. And it's a darn sight easier than trying to work out whether the market's going to go up or down tomorrow.
Well, I'm looking at a share. If your intrinsic value rules also reinforce a company I like, well, I feel comfortable about that. So it's nice having you in our
Let me define long-term investor.
Okay.
Every purchase that I make, I intend to hold for as long as the quality of the company remains very high, so A1, A2 type businesses, and the price is not meaningfully above its intrinsic value. So as long as those two conditions exist, I'll hold it for 20 years. But if those conditions change, if it becomes extraordinarily expensive compared to its value, or the quality of the business deteriorates, yes, I will be selling.